us right now is Brenda Vingiello. She's Chief Investment Officer at Hill Global Advisors, also a CNBC contributor. Let's talk first about the CPI data. Look, the Dow up 366 points. If you missed the rally in the past week and a half, is it over? Is it gone? What do you do now?
I don't think the rally's over, and I think there's certainly opportunity for market participation in the rally to broaden out. You know, looking at what's happening this morning in terms of the futures market, we're seeing small cap stocks, also the Russell 2000, up almost 3% pre-market. So that, in my mind, suggests that a little bit of the cloud is lifting in terms of the interest rate concern, especially among some parts of the market. Certainly not large cap tech, which, as we know, is does not need access to capital and in many cases has a decent growth story behind it. But when we look at other places within the market to invest, there hasn't been a lot of participation. So I think there is absolutely still room for the rally to broaden out. And getting a confirmation from the CPI.
Would it be a real, genuine, long-term rally, or is this you miss the bus, you get that group of people who try to catch the bus, but the bus has kind of left the station, and it's sort of the end of a mini rally, if you will?
Well, I think if the economy hangs in there and we look to what's coming next year, we could have a more normalized earnings growth year, which I think would be a welcome reprieve from the environment that we've been in for the last several years. And that could be a positive thing, certainly, for the broader market. So I don't think that this is it in terms of a rally that's being missed. Because I certainly think there are opportunities, particularly outside of large cap tech, in areas of the market just have not participated at all, for the most part, in the rally this year.
Would you buy a bond at this point? We were talking about how Ron Barron hasn't bought a bond in his whole life.
Well, I think even for those who haven't, if you haven't, now is the time to consider adding bonds. Certainly, when we look at the potential in terms of return, if we do have an environment where interest rates are starting to come down by mid-year next year, that could be meaningful in terms of total return, not only from the yield, but also total return as bond prices rally in that sort of environment. So we absolutely think there is opportunity in bonds. And if we have another year, we could have another year where we get stocks and bonds moving in the same direction, but it would be the right direction in terms of having positive return. Certainly after the last several years where bonds have delivered an absolutely terrible return, that we think that creates opportunity here. And certainly in this environment we're in as well, you know, there are increased geopolitical risks. And if we did see some kind of disruption, because of that, we think that bonds would absolutely be protective in that environment, particularly Treasury bonds.
If rates stay low or they go lower, Brenda, why not just invest in the Magnificent Seven or large cap tech? Because it seems to get a breather whenever we come down in rates. I mean, that seems like the trade. You can extol the virtues of the other, you know, more undervalued parts of the market, but that's where we see the lift when rates come down.
Yeah, I think that will likely be the case through the end of the year. I think as everybody's kind of positioning portfolios heading into the year and window dressing, everybody wants exposure to those winners to show at the end of the year in their portfolios. But I think when we look to what's likely to happen next year, we could see more of a broadening out. Right. And if we've truly had a risk-off move in the market, I don't think those large cap tech companies are going to be as protected as Treasury bonds.